Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, it's Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree Point of View, our podcast. And today we're joined with two different team members of Peachtree, and we're going to talk about government lending. So we have Laurie Ivy, who recently joined Peachtree as part of the acquisition, by us to purchase PMC Capital. So PMC was a SBA lender and will continue to be an SBA lender that focuses on the 7A lending program. And we'll talk more about that later today. Zach Chandler is joining us as well. And Zach joined us, going back several months ago, and his focus is helping us grow into the USDA lending program. Started to focus on these government lending programs because the credit markets, especially as it relates to commercial real estate, is heavily dislocated. And these programs offer a way to help, small business owners, help owners of commercial real estate assets, especially hotel assets and some of these other, properties, to be able to get financing. And the USDA specifically specializes in these rural submarkets. And that's something that attracted us to the program as well. With that said, I'm going to turn it over, Zach, and start with you with a couple of questions. And just want to say, thank you for joining us to start out with. My first question is, walk us through just USDA, because people hear the USDA name and they immediately think, ag lending, agriculture. Obviously, is involved in that area, but they're involved in a lot more. So I'd love for you to talk a little bit more about USDA and what it actually does on the lending side.
Yeah, no, I appreciate you having me on today, Greg. Looking forward to discussing government guaranteed lending here at Peachtree. But like you said, under USDA, there's 17 plus programs with a wide range of support to economic development and quality of life in rural America. Of which one of those 17 programs is called Rural Development. And that's specifically, which is what we're focusing on, is specifically for all your businesses outside of the row crop and livestock in rural America to provide access to capital for. And so, the hard part about rural America is most community banks or regional or national banks, they don't have either the risk profile or the balance sheet to be able to fund these loans. So USDA comes in and provides a guarantee, which is typically 80% of the loan amount, which reduces the risk and increases the borrower's access to capital where we come in. And so, while USDA is Department of Agriculture, basically through all their 17 plus programs, you can build an entire community through, hospitality lending, through, multifamily, through the, C-stores and self-storage facilities, industrial, manufacturing, food supply chain, so on and so forth.
Yes. So with USDA, you can finance all these different projects, and they've got to be in certain types of submarkets. Like you couldn't necessarily under the USDA program, and correct me if I'm wrong, finance a project. Like, for instance, I'm in Austin, Texas today at our office here. In downtown Austin, could you finance a new hotel property that was being built with USDA?
Yeah, no, USDA is focused on rural America. So they have a mapping system that'll tell you if the location's eligible or not. But, the rule of thumb is 50,000 or less inhabitants. And it's actually surprising. There's some larger tertiary markets, like St. Augustine, Pigeon Forge, Gatlinburg areas that are actually USDA eligible. There's a mapping system though. You just plug it in and tell you if it's eligible or not. Got it.
So you go to the mapping system, you can figure out if your specific address, would qualify under the USDA program. And when once it does qualify, ultimately working with someone like Peachtree, that's a lender that's specializing in in the government lending programs. Obviously, we've applied for our USDA license, and we're starting to do USDA or doing loans in these rural submarkets that qualify for the USDA loans. And so once that project does, what are the loan sizes traditionally that you can get through the USDA program?
Yeah, no, for sure. So some of the advantages of going the USDA route is the ability to go up to $25 million. with the USDA one loan, and it's truly a partnership between us and the client because each project we have $25 million of runway. So some clients that I've worked with in the past, I've done over 100 million USDA with. And it's just each project you can do a different new $25 million runway. And outside of that $25 million runway, the USDA also allows us to have creative capital stacks. So we can utilize our ecosystem at Peachtree where we finance CPACE and EB5 as well. So with CPACE, EB5, tax credits can be part of the capital stack. And that allows you to really get some sizable transactions. There was a loan I did where Peachtree was a CPACE lender a few years ago that was about 90 million in the capital stack because of the ability to have 25 million with USDA, CPACE coming in, and some other pieces of the capital stack. So it allows for decent sized capital stacks. And then some of the other advantages of USDA lending are competitive interest rates. It's also long-term permanent financing where we can go up to 30 years, no balloons or calls. So, you have that product there for potentially 30 years without having to worry about having refinance, fees, as well as it's a construction to perm loan. So you don't have those additional fees once the loan gets C of O and perms up. Then, it's a high leverage product as well. We can go up to 80% loan to value on real estate and 70% loan to value on equipment.
Wow. Okay. And are these typically shorter term loan terms or are these long-term loans? And what's the amortization periods?
Yeah. So it's 30 years fully amortizing, no balloons or calls. So that's extremely attractive to somebody looking for a legacy project or somebody that's not wanting to have to worry about refinancing their debt every 3 to 5 years.
So, as we talk about just the credit markets being so dislocated today, especially if someone's trying to develop new property, opening up a new manufacturing facility, trying to open up a new hotel or build a multifamily property, or even someone's trying to build an office building. It's very challenging to get financing for these projects. And theoretically, someone could use, if they're in the right geography, in the US, they could technically use the USDA program to give them up to, if I heard you correctly, up to 80% financing. Is that a correct statement? Depending on, if it's equipment or real estate. If it's a real estate, obviously you can go up to 80% financing. Is that correct, Zach?
Yeah, no, that's correct. Yeah. And then equipment, we can go 70%. We can add working capital into the capital stack and we can do refinancing as well as, business acquisitions. But yeah, we can go 80% on real estate, 70% on equipment.
And then if someone has a larger project, so these are projects under 25 million, or I guess the loan size would be under 25 million, right? So you could technically be building a new project for, say, 30 million and get, up to, 80% financing if you're building a new hotel or apartment building in one of these qualified areas. But then if you're doing a larger project, like say the project was $100 million in costs, you could still use USDA. And for instance, if the project was like in Florida, you could potentially use CPACE. You could bring CPACE into the picture. And then you would potentially have, call it 30% of the project costs being financed through CPACE. And then you could max out your loan with USDA, and effectively, if it's a $100 million project in that example I gave, effectively you could have, over 55% financing through those two avenues and potentially maybe even get higher leverage through like EB5 financing or some other program, you could, attach to it as well. In a very heavily dislocated program, this just sort of points to how, we continue to get creative and try to innovate new ways to help capitalize projects in a very challenging market with the USDA program. So I'm a big fan of the program, and that's a big reason, we wanted to join and really focus on the USDA side. With that said, let's talk about SBA 7A, and Laurie, sort of turn it over to you to talk more about how the SBA 7A program, works. Obviously, you're new to Peachtree. And, through the acquisition, as we talked about earlier, we're super excited about, what's happening with the SBA program long-term, especially, again, because of how dislocated the markets are and how challenging it is for small business owners to get financing. But maybe just sort of start out, like what type of projects can you finance through the SBA 7A program, which is our main focus today? And eventually we'd like to get in the 504 program, but let's just talk today about 7A.
Yeah, with the 7A program, it really has a wide range of uses for the program. You can do a project where there's commercial real estate involved, like a hotel. There can be business acquisitions without real estate. Working capital can be a use. All of those things can be included in a project cost. Renovations has a wide range of uses and loan proceeds types. Many different kinds of commercial real estate. But if it is commercial real estate, it needs to be owner occupied, is a requirement of the SBA. It's not for passive businesses such as office buildings that are rented out to somebody else. You could build an office or purchase an office for your business to operate at, as long as you're using at least 51% of the space.
Wow. Clearly it's a good time to be buying office buildings, just given how much distress they've been under. So, you can buy office buildings cheap. So I didn't realize you could technically buy a building, and as long as you're going to take up 51% of it, it could potentially qualify under the 7A program. And so the limitations on that is it's the loan size, right? Like you can't.
Right. Yeah.
Yeah.
It would have to be obviously a smaller office space, because the loan size maximum for the SBA 7A program is $5 million.
Right. So with that, where would you max out typically on a real estate loan on a loan to value, loan to cost basis? Like what would be the max loan you would provide, looking at those benchmarks for, potentially for an office building where you're 51% or more occupied by the owner, or by like a hotel property or a car wash, self-storage? Like where would it typically be?
I would say typically we would be in the 80 to 85% range is typical. And when there's commercial real estate involved, it can depend on the project. And there are cases where you can have less equity if it's an expansion, and say you own one hotel and you want to expand in the same market, for instance, or in a nearby market. Then if you have equity in that, you might be able to get 100% financing on the new hotel, and they would be treated as an expansion.
And then what's like with working capital, how does that work with SBA 7A? If you wanted just a working capital, like say you had a thriving small manufacturing business and you wanted a working capital line of credit, how do you typically go about it with SBA, or is that even possible?
Well, SBA does have a line of credit product, but that is really a separate subset of the 7A program. So that's not something that we could do right now, but we can include working capital in your project cost. Say if you're buying a business that's in a bit of a turnaround situation, we see that a lot. That might be one of the reasons why conventional financing is not available, that the debt coverage needs to be improved and somebody has management expertise in that industry. They need some working capital to turn that around, perhaps while they're doing renovations or improving the business in other ways. And that can be included in the project cost. And then you're looking at that 80 to 85% leverage on that total cost.
Okay. And then what's like with 7A? So it can be used for acquisition loans. It could be used if you have, we've talked about this wall of debt maturity on previous episodes. Mm-hmm. So you have a lot of real estate loans maturing over the next 12 months. You have close to $1 trillion of commercial real estate loans maturing. And so if you have a hotel loan maturing, technically you could refinance it through the 7A program. That's a potential option. Is that correct, Laurie?
Yes, that's correct. Yeah. Refinancing's an option as long as there's a good reason to be refinancing, like improving your cash flow or a maturity coming up. Really, if there's any balloon in the life of the loan at all, then it's eligible for SBA refinancing with the 7A product, because, with the 7A, it is a long-term permanent loan. When there's real estate involved, that would be a 25-year term. And then it has a prepayment penalty only for the first 3 years, so that you're not forced to refinance later when the time might not be right for you. You don't want to be in the position of having to refinance in a time that's not opportune for your business or the capital markets.
And what's from a standpoint of just utilizing SBA and USDA, has there been situations where a borrower could take for the same project, use both programs? Has that ever been done, or is that just restricted?
Yeah, no, I mean, USDA and SBA collaborate well together, and you can certainly use both programs in one capital stack. It would obviously need to be in a USDA eligible area, but yeah, no, they work great together. It's a great capital stack builder.
So like you could get a first mortgage loan through USDA and then finance maybe the equipment through SBA or something, or is that how it
you can do both through both the real estate. They can do pari passu since they're both guaranteed programs. You can have a pari passu USDA SBA loan that are both in a senior position on the real estate and equipment if there's equipment as well in the capital stack.
Wow. So effectively then, I mean, from a Peachtree perspective, directly, if someone's developing a project, and I mean, because just the difference between SBA, USDA, SBA doesn't really care about the location as long as it's in the U.S. Laurie, correct me if I'm wrong there, but they don't care about the location. USDA does care about the location. They want to make sure it's in the right geography. In both cases, I hate to say they don't care about the location. They want to make sure it's a viable market to develop or to be doing a project. But assuming the market itself makes sense, you could theoretically, and you're in the right geography for USDA, you could get a USDA loan up to $25 million, and then you could be pari passu with an SBA loan up to $5 million. So you could actually get you could finance even a larger project effectively by using SBA as well if you qualified for both programs, technically, I guess.
Right.
So.
Yeah. Potentially you'd have $30 million of runway. Really, USDA is location specific, where SBA there's a size standard depending on the industry. So as long as you check those boxes for both, then yeah, you can mirror those together. And we're hoping very soon that we can also add CPACE into the SBA cap stack, which then we could couple that with SBA, USDA, and CPACE or EV.
No, that'd be great. And then what the processing time? Because one thing I've always heard, people have always been very hesitant to get an SBA loan because they're like, oh, it's going to take me, 6 months, 12 months to get the loan, and I'm going to lose this opportunity. And the same thing about USDA. Everyone's always concerned about the timing that's going to take. It could take years to get the loan, in place because you've got to get you got to process. You've got to get the guarantee in place in both examples, through SBA or USDA. So what is the timelines, and do we have a way to help, expedite the timelines at all on our side?
Yeah, on the SBA side, our average loan closing takes about 60 days. It can go faster than that, and we're a PLP lender, which means that we have the authority to approve the file for the SBA through their system, when the file is complete. So that can streamline the process. And it really depends on the borrower and how organized they are and the type of project and the seller, people like that need to work together to do it quickly.
Yeah. And I mean, from the USDA side, it's a little slower. It's a government guaranteed process, whereas SBA has the preferred lender program that essentially when it's approved at the lender level, it automatically is approved at the SBA level as well, where USDA actually takes it one step further. They have to still review the file and approve it. But one of the biggest benefits here at Peachtree that we offer is a bridge product. So whether it's SBA or USDA, we can bridge, whether it's a refinance, acquisition, or if you're just wanting to break ground quicker because you got the winter coming where you wouldn't be able to do the construction or whatnot, that we can bridge that timing gap so that we can close in more a traditional time frame that you'd see with a conventional or a CMBS loan.
Yeah, and I think, Zach, what you're highlighting is is really a huge benefit. It's really a competitive advantage for Peachtree given our ecosystem and that we're involved in so many different lending programs across commercial real estate, and our ability to do that bridge loan. So if you're acquiring a property, developing a property, and you need to have a bridge facility in place to start the project, and the USDA or SBA guarantee is not fully in place, we can still potentially provide that loan and help you keep the timeline moving. That's a huge advantage for the borrowers, our customers that we're working with. So it's a huge benefit. It's a huge win for everyone. Just to sort of close it out, because we're running up on time right now, what is like some advice? Because I always like to give people just advice as looking to get a USDA or SBA loan. Is there anything you would recommend in order to help expedite the process or help make it a smoother process to ensure that they're successful in that endeavor?
Yeah, I mean, outside of working with Peachtree, which obviously can help you expedite that and get it approved as quickly as possible. When you really want to have a solid business plan and projections, if it's a startup, that's really what the USDA or SBA is going to be diving into to make sure that, and that ultimately the loan's going to be able to be paid back. So, there's, third-party folks out there that can help you create and curtail that. And we'll do feasibility studies and stuff like that to verify, but really honing in on your business plan and projections, how you're going to be able to be successful. And then making sure you're bringing on the right team around you that's experienced, where you might have experience in that industry, but you don't have experience with construction. Bringing in somebody that has the development experience or the operational experience, so on and so forth. And then, really understanding what the administration's priorities are and the program's priorities are, and making sure that your project is curtailed to those programs and administration priorities.
Laurie, any advice you would give?
Yeah, I'd just like to add just to make sure that, you have all your financial statements together. That can really help speed up the process when you're talking about, wanting to get through something quickly. Get all of your financials, tax returns, get the accountants working on that, before you were starting the application so that it can go as quickly as possible.
That's great advice from both of y'all. And just really to close this out today, really want to say thank you to both of y'all again for joining. More importantly, I think we've, really, like, as I mentioned before, we built this ecosystem that really helps borrowers be successful in getting financing. And so if you are looking for an SBA loan or USDA loan, I would highly recommend, reaching out to both of y'all, because y'all have a lot of experience in that area in the government lending side. These are both incredible programs to help, again, in a very dislocated market. It's like today where it's very challenging to get financing, and traditional banks aren't financing at the same level, especially for the small business owners. So a lot of the small business owners aren't being served as they once were. So as they're trying to, buy an office building to house their business, or as they're trying to buy their, first hotel property, or build a self-storage property, or even build housing in these rural markets, a lot of them are struggling to get the financing. And that is a real reason we brought in, we bought, obviously PMC, but brought in Zach, and we're building a team to be able to do the government lending programs, because they really can help.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.